How, under tax law that has been in place since 1913, can you get tax-free access to the cash that's sitting in your cash value life insurance policy? Well, as long as the life insurance policy is designed properly and under the IRS rules and regulations so that it isn't a modified endowment contract or a MEC, the cash value can be accessed by the policy owner through withdrawals or loans, and the proceeds are not even reportable to the IRS, nor are they taxable. That's the important point here. So when one has a properly structured and funded UL policy, it can be an attractive alternative to a Roth IRA. And I call some of these policies a Roth IRA on steroids. In fact, many Fortune 500 companies use UL policies as non-qualified or private supplemental retirement plans to bonus their top executives. Small business owners and other people dreaming of a prosperous retirement are jumping on the bandwagon too, as they learn about the extraordinary living benefits of a well-designed investment-grade UL policy, including the potential for substantial tax-free retirement income through policy loans under current tax laws that have been enforced for decades and updated in the 1980s. And you don't have to access the money for retirement income to get to your money on a tax-free basis. You can use the money for any purpose you want, such as college education, home improvements, to buy a car or whatever. It's your money and it's easy to get access to most of it at any time. You don't need to be wealthy to benefit from what I call a private retirement plan using a properly structured investment-grade life policy. Even people with budgets of only $400 a month can have a hard time deciding whether to fund a Roth IRA or an equity indexed life policy when they weigh all the pros and cons of each. But I don't know of an investment in a Roth IRA where your money can grow at a 2% worst case year and a 14% ceiling in the best years, can never lose past account gains, and has an annual reset feature as well as an explosion clause, which is what I call the death benefit. Equity indexed universal life policies come with an ability to take a loan on the cash value in your policy. And just like when you get a mortgage or a car loan, there's no tax to pay on the loan proceeds. There's also no credit check, since you are simply borrowing against the cash in your policy. Loans are not reported to the IRS or any credit agency, and payment or non-payment against them will not affect the policyholder's credit rating, but they will reduce the death benefit. Like most loans, they require interest payments, and there are basically three ways that insurance companies charge you interest on your policy loan. The traditional loan interest method is where the company charges you a net interest rate of maybe 1% or less, or even a 0% interest rate, also called a wash loan, is charged by many insurers on outstanding loans made from your policy. The insurance company simply credits your policy with interest earnings at the same interest rate they charge you for the loan, for a 0% net charge. There are also variable loans and index loans, which allow your money to continue to grow when the S&P 500 does well, even though you've taken the money out of your policy. Depending upon how the index does, it's possible that you can even make profits on money that you've borrowed out of the policy. For example, the index loan in one policy I often use works as follows. The policy charges a fixed interest rate charge of 6% on policy loans, but the policy still credits the borrowed money with the returns of the S&P 500 as explained in another video. So when the index goes down, your account was credited with 2% floor, but charged the 6% for a net interest charge to you of 4%. However, when the index does well, let's say it goes up by the cap of 14%, once you deduct the interest rate of 6%, you actually profited 8% that year on money that isn't even in the policy anymore. Based on the actual S&P 500 index performance over the past 25 years in that policy, you would have profited by an average of 2% a year on your money that you'd borrowed out of the policy. It's like having your money in two places at once, and you can't do that with a Roth IRA. The best policies allow you to change from traditional 0 to 1% interest costs to the fixed or variable loan from year to year if you'd like, based on how well you think the S&P 500 might do that year. Usually borrowers just let the interest accrue, and both the loan principal and the back interest will be repaid out of the death benefit. Or you can pay the money back to your account at any time, like in the Becoming Your Own Banker financial strategy, which is described on another video. If the loan interest is accrued, it will be deducted from the cash values of the policy. If there's not sufficient value in the policy to cover the interest, the policy will lapse, and if this happens before death, earnings taken out of the policy would then be subject to income taxes. Taking loans on a UL policy can affect the long-term viability of the plan, and we need to make sure that we don't take more money out of the policy than we should. All we have to do is make sure that there is always enough cash in the policy to keep it in force until death, so all loans and interest will be repaid out of the death benefit with no income taxes ever paid or ever due. So let me ask you, would you like to pay taxes on your retirement income? If so, this means you'll have to take more money out of your IRA accounts to be able to pay the taxes and leave you with enough to spend and enjoy. Or would you prefer to avoid paying taxes and just take out of your policy exactly what you need to safely and thoroughly enjoy your retirement years? Tax-free is always better than taxable, isn't it? If the idea of getting tax-free retirement income or access to your own money appeals to you, then contact me and let's take a look at all of your options based on your present situation and your financial goals. I look forward to speaking with you soon.